A year ago this week, something happened. And we have never been told exactly what happened, but there was some sort of crisis in the global economy. Happy anniversary, everybody! This week marks the 1-year anniversary of the beginning of the financial crisis that we are currently in, and we are in a financial crisis regardless of whether the stock markets are going up or not. And it has nothing to do with what happened in March and the world's current global health problem and things like that. Just ignore all of that. Always pay attention to what the world's central banks are doing, especially the Federal Reserve. And that will sort of give you a clue as to whether or not there's something bad going on in the world economy or not. The Fed's stocks policy is exuberantly asymmetric. Now, the Fed is not supposed to have a stocks policy. That's not their purview. They are they're not supposed to be fiddling with the stock market, but they've made it their business. A falling market gets a swift response, but the idea of raising rates to curb inflation, inflated share prices has become outlandish. And so whenever the stock market falls, they respond very quickly, and then there is no action taken as things start to rise. And this first chart down here shows Alan Greenspan's responses, and he reacted to the stock market. It was lagging. The stock market started to crash, and here quite a few months later, he starts lowering interest rates. Stock market bottoms, and it's quite a, it goes up for more than a year before he starts raising rates. And then Ben Bernanke took over in here somewhere. And then when the stock market started to crash, actually, he started lowering rates. The stock market put in a double top. There was something wrong in the economy. Remember the mortgage-backed securities and all of that stuff? So he started lowering rates pretty dramatically and pretty quickly, sort of leading the stock market. And then we get down to something that I like here. This is on Bloomberg. And this chart is pretty much identical to a chart that I've been showing since 2010, 11, 12, something like that. And so there's a bunch of PhDs now that are sort of legitimizing what I've been showing for the past 9 years. So I like that. I think the chart that I generate actually has a little bit more relevance and has a better correlation. This is Fed assets versus the S&P 500. I use the base currency supply, which is a reflection of Fed assets, and the Wilshire 5000 total market cap index, which is the value of the stock market. And then this shows that there's a lag time between what happens in the stock market Fed reaction, and then once the Fed starts creating a bunch of currency, there's a few weeks lag time before the stock market recovers. And this professor, Talis Putnams, I'm not sure, Sydney University, he's sort of legitimizing the stuff that I've been showing for many years, and I went into more analysis of this in my book. I will probably cut it now that a PhD has come up with it. But if we take a look at this chart and we go to a section from my book, The Great Gold and Silver Rush of the 21st Century, which is not out yet. I paused the book when everything crashed because everything was changing too quickly. And I wasn't sure whether or not the stock markets had peaked and everything was over with, and this whole section of my book was going to be outdated. So I paused it thinking I might just scrap these sections. But I'm going to do a video where you're going to see a lot more of this section. But this section is about the mother of all bubbles, and then the next chapter shows that the world is in these massive stock market and bond bubbles, and there were a whole bunch of localized real estate bubbles. But this is the Wilshire 5000 total market cap index, and this is the adjusted monetary base. And the correlation from the start of QE1 to the end of QE3 is an astounding 0.974. Now, If you don't know how correlations work, a correlation of 1 means you're measuring the same thing. If we took the Wilshire 5000 total market cap index from 1990 through to today, and we charted that, and then we took it again and charted that and compared the two, they're the same. They would have a correlation of 1. If you've got a can of Campbell's tomato soup and a can of Campbell's tomato soup, they have a correlation of 1. They're exactly the same. This was a correlation of 0.974. That means the Federal Reserve directly manipulated the stock market for nearly 6 years with a success rate of 97.4%. Therefore, they get a grade A in financial fraudulence. But wait, look, you might say. After QE ended, base currency supply went down, but the stock market went up. That means the economic recovery is real. Well, guess what? I'm not going to show you this right now, but later on in the chapter, I show you that the amount of time since 2008 that the Fed hasn't been actively manipulating the stock market with quite an astounding correlation, a success rate, measures in the months. It isn't years that they've gone without manipulating, it's months. There was manipulation going on during all of this time. So, moving on, I want to get down to black swans and fat tails in that same Bloomberg article. Investors often complain about black swans, the extremely unlikely and very damaging events. A lot of supposed black swans are nothing of the sort. They are merely events that investors had wrongly failed to anticipate. What happened to the world economy in the second quarter, however, is different. Long experience would have suggested that it was frankly impossible. I take exception to that. They go on saying that we'll get back to this in a second. But I want to take exception to this and show you that if they had, this says long experience. What they're measuring here, this is an article that they're going to go into that was from some analysis that S&P Global did. And they didn't go back far enough. And they're talking about the crisis of 2008. Well, if you go back far enough, you can find things like they're talking about the crisis of 2008 and the current economic crisis. And the thing is, if you go back far enough, you can see that their models did not incorporate enough data and their models were wrong. Their models were broken. This is the producer price index of all commodities going all the way back to 1913, January of 1913. And so here, World War I breaks out in This is the Federal Reserve Act is approved in December of 1913. The Federal Reserve opened their doors for business in November of 1914. And then World War I breaks out, and they immediately start increasing the currency supply. Now remember, what they usually do is they buy U.S. Treasury bonds. Well, back then, the national debt was $1 billion at the beginning of World War I. It was $25 billion at the end of World War I. And so they increased the currency supply to support all of this. And then in February of 1918, that was the first reports of the Spanish flu. And then the Spanish flu had 3 different waves of it. And the last wave was in April of 1920. So this is the Spanish flu. And then the soldiers were coming home and the markets crashed. We had the greatest deflation in U.S. history. I used to give presentations with Robert Kiyosaki all the way back in 2005, 6, and 7, and I called this the Depression of 1921. I was the first one to coin this as the Depression of 1921. And what was amazing is it was over with in no time at all, simply because the government and the Federal Reserve did not rush in to try and save us. Within a year and a half, this depression was over with. Now look at the scale of this deflation. This is the Great Depression right here. It's nothing compared to the Depression of 1921. But here, the government, the Federal Reserve, rushed in to save us right away. They started manipulating things, and they turned this into, this is the what's called the Roosevelt recession within the Great Depression. So this whole area here is the Great Depression. And then we have World War II and the expenditures. And, you know, these are very interesting interactive charts. You can expand these and see the prices rising. But if you go all the way out to today, this is the end of August of 71 is the end of the Bretton Woods system right there. And you can see a change in the direction of prices. So that's the Depression of 1921. The Great Depression is all across here. And so let's go over to currency in circulation and take a look at what that looks like back in the... so here they're ramping up the currency supply, the Federal Reserve, and then April of 1920, the Spanish flu is over with. It keeps on rising for a while, the currency supply, but then there's this big deflation that happens in 21. And so that's there is something that they could have looked at if they had incorporated this data and said what was happening during, we had war and we had a global pandemic going on, and then there was this big deflation right afterwards. Here is an index of common stock prices of the New York Stock Exchange. So this is all the stocks on the New York Stock Exchange. And what you see here is an inflation happening and a big blow-off top toward the end of World War I. World War I ended in November of 1918, and soldiers coming home. The Spanish flu ended in April of 20, and so March, April, right there at that last peak, and then stock market crash. And so there is data that they could have gotten to say that what has happened was possible. Black swans and fat tails. Many of the problems from 2008 crisis stemmed from modeling assuming that outcomes would follow a classic normal bell curve distribution with only a few outliers. 95% would be within 2 standard deviations of the norm, and 99% would be within 3. The problem arose when bell curves stopped looking like bells and became asymmetrical or developed fat tails with a big number of outcomes that fell more than 3 standard deviations from the norm. Now, let's look at some bell curves here. This is a standard bell curve. And so 68.3% of all of the probabilities and outcomes typically fall within 1 standard deviation. That's this. 95.4% within 2 standard deviations, and 99.7% within 3. So that means only 0.3% fall outside of that 3 standard deviations. Let's look at some of the likelihoods. Now, this all has to do with the question, does the Federal Reserve and the world's other central banks know what they're doing? I believe they don't, and I think some of the data in here, once you see it, you're going to come to the same conclusions. So this is from Wikipedia, and this is standard deviations. 2 standard deviation happens like once every 3 weeks. 3 standard deviations yearly. 4 standard deviations once every 43 years or twice in a human lifetime. 5 standard deviations once every roughly 5,000 years or once in recorded history. 6 standard deviations, 1 in every 1.33 billion years, or twice in the history of humankind. And then a 7 sigma event is once every 1 billion years, or 4 occurrences in the history of the Earth. Now, what's interesting is that first occurrence would have happened in a period of time. If you see here, this is this portion here marks the late heavy bombardment. The late heavy bombardment, the Earth was molten. It developed a crust, and then a whole bunch of meteors. There was this huge period of time where a lot of meteors struck the Earth, and we wouldn't have any gold available to us on this planet if this hadn't happened, gold or silver. When all of these gold-bearing asteroids struck the crust, it melted the top layer of this crust, but there was already a mantle that had formed underneath that. So the gold, the creation of the Earth, there was a lot of gold, but it all sunk to the core because it's so heavy. So it's not accessible to us. This late heavy bombardment is the reason all gold that's in the Earth's crust that we are able to find and dig up exists. But basically, the first one of these seven sigma events, the first one would have happened when the Earth's crust was still molten. So moving on. The problem was that the bell curves stopped looking like bell curves and became asymmetrical, or developed fat tails with a big number of outcomes that fell more than 3 standard deviations from the norm. Now let's look at the bell curve for quarterly GDP growth in the US and the Eurozone since 1995, as assembled by the team at S&P Global. We will come back to this in a second. Until this quarter, the graph does indeed look like a normal bell curve with a touch of kurtosis, meaning that it has a peak that is a little high and tails that are a little too long. It was also slightly asymmetric, with the EU in particular being far more likely to deviate to the negative side. Untrue, the author here has these reversed, negative and positive side. I'm going to show you that right here just so you know what kurtosis is. And this is a normal one. This is positive skewed to the left, negative skewed to the right. If I was naming these, I would have named the exact opposite, but I wasn't around then. And this is kurtosis. Leptokurtic is tall and skinny. Platykurtic is a short, fat bell curve. So, getting to the chart. This is a hard chart to read. It took a little while to figure out what was actually going on here. The US is blue, Eurozone in orange. The positively shifted, now they said negative in the article. Notice that the peak for the Eurozone is shifted toward the left, and the peak for the US is a little bit more centered, maybe even shifted a little bit more to the right. So the Eurozone has a positive shift, the US a negative shift, but in this case, and in most cases, the negative shift would be good. Now, the way you read this chart is this is the number of quarters from 1995 to 2020. So this is 100 quarters of either measuring growth or contraction. And this scale across the bottom here, very poorly labeled. But basically, this is deflation. It's not deflation, but negative growth. Yes, it's deflation. It's quarterly GDP contracting of 0.5% to 0.1% of contraction. And that is this one right here. So this one, that scale is missing. That would be 0% to 0.4% growth. This is 0.5 to 0.9, 1% to 1% to 1.4% would be this. And what they're doing is this height right here is 1 quarter. And so this is the number of quarters, and they're stacking them up. And so the US has had in the 100 quarters that exist during this period of time, has almost 50 though of them, close to half, have fallen in this range where we grew at a rate of 0.5 to 0.9%. And then along came the global health problem, and the second quarter of 2020, we contracted 9.5 to 9, that range of 9.1 to 9.5. The Eurozone, 12.1 to 12.5 contraction. It's actually larger than that. It depends on whose data you're looking at. But moving on. So now that you know how to read this, so this is the bell curve, and this is a fat tail or a long tail that is statistically impossible. Now, if they had gotten data going back to the last global health problem back in 1917 and 18, back in 1918 through 1920, they would have incorporated some data that would have supported that. So, Paul Grunwald, the global chief economist at S&P Global Ratings, estimates that the U.S. and the Eurozone's second quarter growth numbers were 11 and 17 standard deviations away from their respective means. This compares with 3 and 4.5 standard deviations, respectively, for the worst of the global financial crisis. This reminds me of a darkly comedic incident in the summer of 2007 as the forces that would create the crisis were beginning to make themselves felt. A group of quantitative funds. Now, quantitative funds, these are funds run by people that are called quants. They're quantitatives. They are calculator-brained people that analyze things. Had all simultaneously suffered a series of losses that the models suggested were statistically impossible. Goldman Sachs Group was obliged to spend money to bail out the funds. Asked to explain what had gone wrong, the chief financial officer of the time, David Viniar, said the models were buffeted by 25 standard deviation events several days in a row. This provoked a great post-bag of statistics professor, one suggesting that consecutive 25 standard deviation events might never happen, even in the full history of an unimaginably large number of universes. Now, the universe is 13.8 billion years old, and I don't know if an unimaginably large number is a million, a billion, a trillion, a quadrillion, a sextillion, or a googolplex. I have no idea what an unimaginably large number is, but it's definitely a number so high that only dogs can hear it. So, another way is what Viniar was saying, using statistical jargon, is that what had happened had not in fact happened. What had just happened had not in fact happened. What he really meant was that Goldman models were totally failed to predict just how likely such an event was, which means that the models are broken and the Fed's models are broken. This is Goldman. Goldman pays the big bucks. They've got the best quants. The Fed's quants are second rate compared to Goldman's quants. I guarantee you, the Fed does not pay the big bucks. Goldman does. 5 sigma, so this is a masterpiece of the Genier. 5 sigma event corresponds to an expected occurrence of less than 1 day in the entire period since the end of the last ice age. 6 sigma corresponds to an event expected 1 day in the entire period since our species evolved. We covered that. 7 sigma event, one occurrence in less than once in a period, approximately 5 times the length of time that has elapsed since multicellular life evolved on this planet. 25%, a 25 sigma event confronted them with problems as Excel didn't have enough numbers to cover it. I think this is hilarious. That means it's impossible. What it means is that they're not taking into account the actual possibilities. Their models are broken. And one of the things that they use is these dynamic stochastic equilibrium models. And as Jim Rickard points out, this is what's actually happening. Needs complexity models to analyze it. Anyway, here we are. Happy anniversary. The crisis actually started a year ago this week. This is repurchase agreements. So this is Fed assets on the Fed's balance sheet, repurchase agreements, the week average. And what you see here is Alan Greenspan's response to the potential Y2K bug, and then when he took currency out of circulation, the NASDAQ peaked and crashed. We had the tech bubble pop. And so this is the response to all of that happening. This is 9/11. This is Ben Bernanke's response to the 2008 global financial crisis when it comes to repurchase agreements. And then they stopped using these things. Everything used to be these dials and levers. And they used to dial up interest rates and the currency supply and, the different, a little bit more open market operations. Now everything is a switch. They switch it on, they switch it off. Or it's a button. You push it in, push it on. And you can see that they just switched this off and it went to absolute zero. And then a year ago this week, something happened. And we have never been told exactly what happened, but there was some sort of crisis in the global economy. And there was these repurchase agreements. This is when a bank needs an overnight loan. They have a sudden drastic need for cash. Now, a lot of these repurchase agreements get rolled over day after day after day. There's also week-long repurchase agreements and month and year-long and so on, but they're much more rare. Usually, it's rolling one-day repurchase agreements, 24-hour repurchase agreements. And what you see here is they switch it on, and then they switch it off, like last March or something. But don't worry, because they switch other stuff on and off. This is U.S. Treasury bills. Now, there are bills, notes, and bonds as far as U.S. Treasuries. Bills are under 1 year. Notes are 1 to 10 years. Bonds are 10 years or over 10 years. And so what you see, global financial crisis of 2008, what they did was they took these Treasury bills and they swapped them with banks for the toxic assets the banks had. So they were swapping getting things like mortgage-backed securities and such off of banks' balance sheets, giving them safer assets such as U.S. Treasuries. And they went down to zero here. And then suddenly, bam! there's no more dials and levers and fine-tuning of things. It's flick, 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 flick. And so going on with it, here's total assets. And what you see here is they give a bunch of bonds to the banks and swap out stuff. So this is assets, securities held outright. So this is the securities that they had fell, but there were other assets that went up. And then this is QE1, QE2, QE3. This is the taper. And then this is the beginning of the financial crisis that we are currently in. It didn't start with the stock market crash in March. And so moving on to the next chart, this is U.S. Treasuries held outright, so it's Fed assets. And here you have the global financial crisis of 2008, and they're swapping out those bills. And then this is QE1, QE2, and this is millions of dollars acquired each month. Or each week, I'm sorry. This is the Wednesday level, each week. And this here there was sort of a pause where it nets out to zero. And then here, it's this positive accumulation over a long period of time. That's QE3. This is the taper. And then 1 year ago this week, the financial crisis that we're in now starts. Do you really think the Fed knows what they're doing? This is mortgage-backed securities, Wednesday level. I think that they're just recategorizing this. This is the commercial mortgage-backed securities, a little over $9 billion. Residential, a little over, it's almost $2 trillion. You stack that $9 billion on top of here, and you get the total. I think that they're adding two new categories to measure this, and the categories are splitting out mortgage-backed securities into residential versus commercial, because here's the total. And they start this split out like right here. So this is the total, but we're almost to $2 trillion, which means the Federal Reserve owns more real estate. They are the lien holder to all of these properties. They can't, if somebody can't pay, the Federal Reserve is the lien holder. They're basically the owner of this real estate until that real estate gets purchased. Now, if it's $2 trillion, remember, you have to put something down, and you might gain equity in that. So that means the Federal Reserve probably owns like $3 trillion worth of real estate because they're the lien holder on that real estate that has most likely a higher value than the mortgage-backed security that that loan was packaged up into. So getting to the point of all this, the Federal Reserve gets to counterfeit currency into existence and buy up more real estate than any entity on the planet, and now it goes into the stock market. This article, the Federal Reserve becomes the world's biggest investor. And what it talks about is that their balance sheet has just expanded and it hit a record. The Federal Reserve hit a new milestone in the race to have the largest balance sheet in the world. And they've been creating currency nonstop in 2020, just going berserk. And then you get down to this chart, and we'll go up to a close-up of the chart. And they start with assets, in the size of the position of treasuries. And then they go down to the bottom of this chart, and AT&T, AIG Global, 3M Company, there are now 22,913 items on the Fed's balance sheet here. So what that means is that they're adding more and more and more complexity to their system. They're adding more switches and buttons to push. I don't know if you've ever seen one of these guys that spin plates, but there's this long stick that sticks up from the floor, some mounting platform, and the guy will put a plate on top of it and start spinning it, and then just get that plate going, and then he does another one, and then another one, and then another one. And there's a certain point where you add too many of them, and trying to go back and keep these other ones spinning while you're adding another one just becomes too much. And there's a certain point where they just all start to crash to the ground because they made the system too fragile. And we are getting to that point where the Fed has made everything so complex and so fragile that I am really concerned that we could see a major potential collapse of the global economy because of adding continuous complexity into the system. Anyway, I want to ask, do you really think the Fed knows what they're doing? And I also want to say, happy anniversary. We'll see you next time.